Zoom. All right. Sarthak, I was just introducing myself, and I was saying that Ria was. We're missing Ria today because she's on vacation, and we're just going to be covering some basics on small business taxes and how to structure your business and whatnot. Right. So, quick background on who we are. So we founded FinSight CPA and Analytics. It's a full service CPA firm. We have client base across US, Korea, Thailand, Australia, and Mexico. I've been practicing since 2015, and the website is FinSight, FINSIGHT, CPA.com. So it's like finance and insights mixed together. And in the course of operating a CPA firm, we found that the technology side was lacking for accounting and taxes, especially for the CPAs out there, right? And for the clients as well, because if you think about, a lot of interaction happens over email, and which is not as secure. So that's when we decided to found our own tech platform as well. It's called TaxZen. So it's tax and ZEN. So it's basically the Zen state for all taxes. So it's a tech platform focusing on technology and tax and accounting. It's an algorithm-based tax marketplace to connect you to the right CPA based on your tax needs. It was founded in 2019, and the website is www.taxzen.com. We also have apps available for both Android and iOS for TaxZen. Still work in progress on the app side. That's about us. For the agenda today, we're going to cover organizational structure, LLC, S Corp, C Corp. Typically, this is where a lot of confusion happens for clients and anybody who's trying to start a business, right? And what can you deduct? What can you write off? And a couple of years ago, the Tax Care and Jobs Act was passed, which impacted the majority of the impact was on businesses. And at the end, we'll open it up to Q&A. So let's get started. On the organizational structure, so there are a couple of things, right? In terms of business structures, it will help you CYA in terms of liabilities, and just forming a business is also better for tax purposes, right? And the importance of record keeping. So primarily, there are like 4 types of businesses. So if you are, the most common form is like, hey, you want to start a business, you decide to sell something online, or you want to open up a restaurant, you just go out there, get release a place, or if you're online, just open up a Amazon account, right? And then you can start selling. But what you're doing is you're exposing yourself to a lot of liabilities. So for example, if something happens at the restaurant and somebody gets sick and they sue you, they can personally get their hands on like your bank account, your house, and whatever you have in terms of your assets, right? So you're personally liable for all financial obligations of the business. The second one is partnership. You talk to a friend of yours and both of you want to start a restaurant, and then you get into a partnership, right? In that case, you are taxed as a partnership. It is a pass-through entity, and the partnership does not pay any tax, but it's going to flow into your personal return, individual income tax, where you will pay the tax. The other type of entity structure is corporation. So this is more like this is for big corporations. So, for example, you have Home Depot, Walmart, Amazon, right? All of these guys are C corp, and they require extensive record keeping, and there are also a lot of regulations in terms of what you have to follow. And the most common form of going into business and not being personal liable for any of the financial obligations is an LLC. I'm pretty sure you've heard the word thrown around, right? Oh, just incorporate an LLC. So you incorporate an LLC at the state and get EIN, which is Employer Identification Number from IRS. And based on those two, you can start your business licenses aside, right? I don't want to go deep into business licenses because each industry is different. And after that, you can open up a bank account on your own company's name. So what having an LLC will shield you is from being financially liable for any of the things that come out of regular operation of the business. So, for example, in my old example of you open up a restaurant and you get sued, what they cannot do is they cannot come to your personal side and put their hands on in case like everything goes fine on the other side at the court, right? And they can only sue you up to where your business ends, and that's it. Until and unless you sign, like let's say you went for a loan, and with the bank you signed an agreement saying, hey, I'm going to be guaranteeing this loan, then they can definitely come at you even though you have an LLC. But in terms of legal matters, right, they cannot come into your personal side. So that's the benefit of having an LLC. And also there are tax benefits as well. So once you open up an LLC, so LLC is considered a disregarded entity for tax purposes. So what that means is even though you have an LLC for tax, you're still regarded as a sole proprietor. So when you file your income taxes at the end of the year, you file something called Schedule C. So that's where all of your income and expenses for your businesses go in, all of your deduction go in, and then you get taxed at your net income level. In my other example of partnership, so you can elect to be taxed as partnership as well when you have an LLC. So LLC is very flexible. That's why it's best to just get an LLC and work with your CPA to or work with a professional to structure it in such a way that's beneficial for you in terms of taxes. Because like the famous saying goes, right? It's death and taxes. It's like everybody has to pass that one way or the other. So in terms of LLC, just the difference between just the flexibility of being taxed is a major advantage. The example that I gave was for restaurants, but I also want to touch on, let's say you're a tech platform, right? And you want to raise some money. So it's not best to go with partnership or an LLC. That is where you got to go with a corporation, because the goal on the tech side is more like to scale the business all the way where you can raise funds or eventually have an awesome exit, which is going to make you a multimillionaire, right? So in that case, all the investors are going to look for is a good C corporation structure in place where you need to follow a lot of regulations, right? That's on the business structure. And at the end of the year, the way you will know is if you don't know about these things, right? and we have a lot of clients who do not know about these. And what I tell them is they didn't start their business to learn any of these. It's just for informational purposes. So if you see a Schedule C on your tax return, you're a sole proprietor or LLC taxed as a sole proprietor. If you see a K1, if you receive a K1 and see a K1 pass through on your 1040, right? You have either a partnership or an S corp. So, I forgot to touch on the S corp. I will touch on that as well. And if you have a corporation, you do not get anything except when you get dividends. So you get a 1099 div. And S corp is one of the things that I don't know why I didn't put that on this slide. But S corp is one of the things that's super beneficial between LLC and a C corp. So like I mentioned before, right? C corporation or a regular corporation, they have a lot of regulations that they need to follow. So what you do is you can register an LLC and elect to be taxed as an S corp. What that essentially does is it avoids the double taxation that happens for a C corp, with all the benefits of the C corp and less regulations. And I'll definitely add that to this slide as well. And majority of our small business clients are S corps, just because of the benefits that it provides. So it's somewhere in between partnership and your C corp. All right. So once you start a business, or if you work for somebody else who gives you a 1099, right? You can still flow that in as if it's a business. So another thing that I want to touch quickly is employee versus independent contractors. So the difference is in the tax treatment. So the way IRS looks at what's an employee versus what's an independent contractor is all goes into like how the income is reported. So if you get a form W-2, you are an employee, right? What that basically means is your employer can control your schedule, where you work, and what you use to work, right? For example, if you work for a big corporation or any other small business out there, right? They can control your hours. They can control like where you work. So if you work for a business where they have multiple locations, they can put you in A location versus B location, right? And the tools that you use to work, like giving you with laptops, right? Since you won't be using your own. So you will be considered an employee. So with an employee, you report your income tax in Form 1040. If you're an independent contractor, you report self-employment tax, where you do not get a Form W-2, but instead you get a 1099 MISC or 1099 NEC. So if you received one of these forms, you can flow that into your tax return and also claim expenses. So for example, if you drove anytime last year for, let's say, Uber or Lyft, right, you will get a 1099 NEC. They changed the form name from 1099 MISC to 1099 NEC, but that basically means that you are an independent contractor for that company and not an employee. So what you'll do is you can still treat that as a business and flow that into your tax return. But if you're a business owner, it typically depends, but you can either pay self-employment tax or have withholdings as well. So you remember when I was talking about the S corp and C corp, if you typically have those two elections, you can start withholding as an employee, but generally you will be paying self-employment tax, and that is the biggest advantage of S corp is that it avoids self-employment tax. Sorry. So what do you do? What do you get is end of the year? You get a K1, and you have to make quarterly estimated taxes. And the forms included for the tax return are 1040, Schedule C, Schedule CEZ, or Schedule SE. So if you have any of those forms, that's how you are structured as. So that's where it has a lot of advantages in forming a business. It's just like the expenses that you can claim. Like let's say, for example, you work for somebody else, and then you get a Form W-2. The laptop that you bought, you cannot deduct it. But if you have a side gig or a side hustle, right, and you're trying to get into IT consulting, or you're doing XYZ, and then the laptop that you buy can be deducted for taxes, given that there are certain guidelines of how to go about doing that, but it's always a better structure to follow. Right? That's the difference between employee and independent contractor. And if you have a business as well, right? So this is going to be a very important question, because IRS can always come back at you and look at all of these different criterias of like what control you have over the person who's doing the job, what hours, if you have any control over the hours or the equipments that they use. Because typically when you have an independent contractor, you do not have to withhold taxes, and you do not have to pay the employer side of taxes. That's why majority of small business, they try to sneak in with independent contractor, but the IRS can come back and reclassify them as an employee, which will open you up to a lot of penalties and taxes that you would owe. Because they can go back and then say, all right, since Jan 1, this person can be classified as an employee, and you owe employer side of taxes and employer withholding from Jan 1. And then any penalties or interest that they assess is compounded at a daily level. So simple interest versus compound interest and compounded daily, it's going to make a big difference. All right. So this slide, I think I jumped a lot deeper into this slide on the other slide. So this is where like the factors that the IRS is going to take into consideration when classifying employee versus independent contractor or self-employed is behavioral control, financial control, and type of relationship. So for an employee, behavioral control would be the company or business controls the work you do, right? And how the work is performed and what tools they use. Financial control is the company has the right to direct and control all businesses and financial aspects of the job. The type of relationship is more like it's expected to be permanent or at least like longer term. Like think about with Lyft or Uber, right? You can say, all right, I'm not feeling it. I don't want to go out there and get more rides because you're an independent contractor. But with your job, if you wake up and say, oh, I don't want to go to the job because I'm not feeling it, then you get into trouble, right? There are certain policies in place for that job that you need to follow. And if it's not followed, then you get into trouble. So I want to touch on write-offs as well. But before we do that, let's open up to questions on just business structure and employee versus independent contractors and see if anybody has any questions. Brishang, are you seeing any hands raised on Clubhouse?
No, I haven't seen.
Got it.
Saurav bro, मेरो एउटा सानो क्वेसन छ यार.
हजुर.
के रे हामीले चाहिँ फर इक्जाम्पल अस्ति यतिकै कुरा भइरहेको थियो, हामी चाहिँ केहीजना साथीहरू मिलेर यहाँ भित्रसँगै बसेर ट्रेडिङ गर्छौँ होइन. अनि वी वर ट्राइङ टु फिगर आउट अ वे वेयर हामीले सबैले एउटा फन्डमा पैसा हालेर अनि त्यसपछि नट अ बिग अमाउन्ट अफ मनी, स्मल अमाउन्ट अफ मनी एन्ड वी गिभ समवान टु डु द ट्रेडिङ के. अनि त्यसमा चाहिँ ट्याक्स फेरि कसले तिर्ने अनि त्यसपछि जसले गर्यो त्यसकोमा हुन्छ भनेर कुरा आइरहेको थियो. अनि पछि वी फिगर आउट यु क्यान एक्चुअली रेजिस्टर एलएलसी, हायर समवन विथ फाइनेन्सियल एडभाइजर लाइसेन्स एन्ड बेसिकली टु डु इट होइन. तर ट्याक्समा चाहिँ लाइक हाउ डज इट वर्क अनि इन टर्म्स अफ ट्याक्स एन्ड ट्रेडिङ like is small amounts of money not even worth the try? Two questions.
Yeah, sure. So that's a very good question, right? So I think I covered it in the business structure type. So you would be considered a partnership, and you don't really need somebody with a financial advisor license because you are in the business to trade, right? So because once you get the financial advisor involved, then there's a lot of FINRA rules that you'll have to follow. So what you can basically do is register an LLC. Then at the end of the year, when you file your taxes, you will be filing a form called 1065, which I don't recommend you do by yourself because once it comes to business, taking a DIY approach is not advisable because you'll be losing out a lot of money, right? So what you'll have to do is file form 1065 where you can treat. So there are a lot of nuances that you'll get into once you're in the trading business, right? And then you can treat all of your incomes and expenses and deduct your expenses to come up with a net income. And that net income will be flown into each of the partners' individual taxes via K1. But since you will be not operating, you will be operating as a business for the sole purpose of trading, there are other rules that come into play as well. Does that answer your question?
Yes, sir. Yes, sir. त्यही हाम्रो चाहिँ त्यो ट्याक्सको कुरा कसरी हुन्छ अनि त्यही कुरा गरेको थियो. अनि in order to file for a company like hedge fund like company, you have to have someone त्यस्तो कुराहरु मैले पढेको थिएँ. So that answers my question. Thanks.
Yeah. If you are trying to raise some big amount of money, then like त्यही भएर म चाहिँ त्यो complications-हरु आउँछ भनेको it depends on how you structure it. At the end of the day, what the rules and regulations that you need to follow depends on the purpose of the business that you go for, right? They are like from the sounds of it, it's more like you're trying to keep it lower investment so you can all come in as a partnership. So if you don't have a CPA yet, I recommend you do work with them because they can help you structure in the right way where you are not going to be treated like a hedge fund, because as soon as you go that route, you got to get into FINRA, you got to get into all of these regulations. But if you're just trying to do small things, like there's a certain way you can get away legally with it.
Hell yeah, bro. We may get in touch with you after I talk to my team.
Definitely.
And yeah, I'm going to say like basically do good deep trade दिने अनि we'll see and कस्तो हुन्छ त्यो ट्याक्स कसले तिर्ने भन्ने कुरामा चाहिँ हामीलाई एकदम भइरहेको थियो.
Yeah, sure. Your tax thing, it flows into individuals. So let's say if you make bucks in profit, right? So four of you are going to get 4K ones, where each one of the if it's like equal partnership, right? 100 divided by 4 is like what, 25. So it's like you guys will flow 25 bucks of income into your personal tax return. And then let's say one of your friends makes 250K, then he will pay like his marginal tax rate for that 25 bucks. But let's say one of your friends makes 25K, then he may not even pay taxes on it. So that's why it's like it differs at the individual level.
Thank you, bro. Thank you, bro. The structure, like saying, we may reach out to some professionals so we get the
Yes,
best
definitely,
business
definitely.
structure.
Yep, definitely.
Thank you for the service.
Yes. Right. Do we have any other questions in terms of business structure and employee versus independent contractor?
Hey, I'm not sure. That was definitely a lot of information that you provided,
Mm-hmm.
and I know that you were mentioning that you have a couple of slides, right? So it'd be very helpful maybe if that can be provided, like after this workshop.
Yes, I
That,
think
that was really
Brishank
good
is.
information.
Yeah, so we are recording this on Zoom again, so I'll be posting it on YouTube as soon as probably by tonight or tomorrow, depending on when it like uploads. So just check SNN for the YouTube video, Avash.
Awesome. All right. Thanks, Prashant.
All right. So let's and I will before I so I think we can add a link to the slides as well. I will add S corp in here because I don't think I lumped S corp and C corp into one. So let's move forward. All right, write-offs. So even if you get 1099, remember I was saying that it could be treated as a business on your Schedule C. I think these are 2019 or 2020 numbers. I think it's 58.5. Let me update the numbers as well because these numbers look to be from a year ago. So, but basically, use of vehicles, right? So businesses can deduct 58 cents per business mile for business purposes, or actual auto expense, gas, repairs, maintenance, parking, tolls, depreciation, etc., multiplied by the percentage use of business. So one thing that we find a lot of people do in this case when they take the DIY approach is like they try to go the actual auto expense way because they feel like they get the most deduction. But if think about the regulatory burden on this one, right? Because at the end of the day, if you get audited by the IRS, you got to pull up every single like not receipts. You can still go with bank statements, but like the proof of the burden of proof rests on you to prove that all of those were business related. So via the CPA firm, that is where like we get a lot of IRS resolution clients. Um, we had a client who back in 2016 used actual auto expense, right? And it amounted just to $1,700, but he showed about 35,000. I don't know how he came up with that math, but when he got audited and after everything went through, now he owes 93,000 for that small mistake. Right. So it is always, so one thing I suggest if you take the DIY approach, or even if you work with your professional, like just take the business miles section and be done with it, because the headache that you expose yourself to is not worth that little bit of extra money that you would get as a deduction, right? It's like this is the biggest thing that I advise our clients as well. Let's just go and they try to refute it. They're like, oh, let's use this. I have receipts. I can back this up. And I'm like, just the administrative headache that you have to take on if you do get an audit is crazy. And that's where like our bill goes up too, because the number of hours that we have to put in is like tremendous into this, right? And on the personal side, it's 20 cents per mile, driven for medical or moving purposes. I think the moving purpose got taken away, and 14 cents per mile driven in service for a charitable organization. So on the personal side, it kicks in only if you itemize. So I'm not sure how familiar you guys are with the tax return in general, but there are two ways that you can claim deduction. One is a standard deduction, one is itemized deduction. And I think we covered this on our last topic on individual taxes. But you can only deduct your personal miles once you start itemizing. So what that means is and typically it happens if you have interest or taxes that you pay that are, higher than your standard deduction. For individual, the standard deduction right now is around 12,000, and for married filing jointly, it's about 24,000. So if the interest and taxes combined are more than 24K if you're married filing jointly, then you can itemize, and then you can start itemizing where you can deduct your medical, you can deduct your donations to charity, right, and even other things, right? And depreciation of vehicles, if you claim the business miles, that covers the depreciation as well. So you don't have to worry about depreciating it or like keeping track of what type of convention that you got to follow on this one. So I would say always keep it simple, but don't keep it stupid when it comes to taxes. All right, write-offs. What else can you deduct, right? So you can deduct the amount that you paid in terms of technology: phone, cell phone, monthly phone bill, internet, computer, like software, professional fees, legal and attorney fees, state filing fees, accounting and taxes, right? Continuing education, contractor fees, marketing, professional photos, flyer, poster, as ad spend, right? Administrative as well. Like if you hire an independent contractor, or if you have an employee, the posters that you paid, printing, dues and subscription, all of this can be deducted. There are certain things that have some limitation in terms of deduction. Let's say entertainment. So part of our CPA firm, operating a CPA firm, I'm not sure how many of you have been exposed to, as like, I have a bar in my office where like when my clients come in, like we have beers and drinks, right? And that is not deductible because that's considered entertainment. So any money that I spend on that side, I cannot deduct it. Or if I take my clients to games, right? So I'm a big Atlanta United fan, a huge soccer fan, and I'm one of the founding members. And before I used to take select clients to games as well when I went. And before I could deduct those, but now I cannot. There are certain ways around it. So all of these, there are still going to be loopholes. That's why you gotta work with a good CPA, where even if it's not deductible, there are certain ways you can make it deductible. So meals is, there isn't any way around it. It's 50% deductible, like regardless of what you do. 100% deductible if it's for a team building event or a marketing event. So meals can be deducted 100% and the way to prove that it takes a lot of admin resources to make it 100% deductible. So the recommendation would be stick to 50%, your life will be happy, right? And this is the 50% meals is for yourself. Now, when you travel, so you cannot say, "Oh, I spend $10 for lunch and $20 for dinner," and start deducting that. So it will have to be when you're outside of your home business area or dining with a current or prospective client, consultant, or a vendor, for employees in the office, or at an entertainment event. All right. Uh, those are the write-offs. So there's one big write-off that people miss, is Section 179. And Section 179, I'm not sure how many of you are familiar, but it's more like, let's say you bought a car for your business, and that car cost $20,000. So this is one of the tax planning strategy that we do with our clients, is like, all right, you bought that car, but let's also look at your profit, right? And depending on that, we can take the right approach. So what Section 179 essentially does is that 20,000 that you paid for that car, you can either depreciate it over 5 to 7 years, depending on how you classify it. So essentially what IRS is saying is, okay, you exchange your cash for an asset, but you're not going to get the benefit this year. You will have to extend the benefit of that asset for a longer duration of time. So what that essentially does is, it makes sense from an accounting perspective, because you want to depreciate your assets over its useful life. And for tax purposes, what it essentially does is it essentially lowers your, it's a deduction, so it lowers your taxable income. So that's why IRS does not want you to deduct everything this year. But if you elect Section 179, if you have, let's say, 100,000 of net income, and you bought that $20,000 worth of car, you can take the whole 20,000 as a deduction, where your 100,000 net income get reduced to 80,000. So essentially, you're paying less in taxes. You can also deduct business use of home. There are certain exceptions when it comes to S corp. But what you can deduct is, you can deduct up to $5 per square foot of your home office space, up to 300. So let's say last year you got a 1099, and due to the pandemic, everybody was at home. So there's a certain office space that you dedicate just for your office work. Then you can deduct that $5 square foot for up to 300 square footage. Or you can also, similar to miles, you can also deduct your actual home expenses multiplied by the percentage of the home office that you occupy. But again, similar to miles, it is going to be an administrative headache to prove how much space that you dedicate to your office, right? Also, there's another actual method of expenses where you pull in your mortgage interest, property taxes, utilities, maintenance, depreciation, HOA fees, insurance, and so on. You can also deduct your office furniture and office equipment that you've bought for business use. All right. So before we move on to another section, any question on the write-offs and Section 179 and business use of home?
Hey there, I have a quick question.
Yeah.
So I just joined the conversation, so I just heard something about write-offs. So I just had a quick question. I was looking at some Instagram videos on real estate, like and house flipping and stuff. So apparently entrepreneurs, they can like build, like this guy has built a basketball court on his property, and he's had a few business meetings on the court. I think he like claimed conference expense or whatnot, and he was able to deduct some of the building costs of the court and get some of his money back. Are there like things like this as well when it comes to homes and whatnot? I know he has a car and he used that as a business car. He bought a Tesla and he had to claim it.
Yes, that's a very good question, and that's what we're talking about in terms of write-offs as well, right? So that basketball court is very similar to meals. So meals, like, you cannot deduct meals when you're just having lunch by yourself. But if you take a prospective client, or you're traveling for business, or you're taking your employees out to lunch, or at an entertainment event, right? You can deduct those, but only up to 50%. So that basketball court example makes sense, but you can still deduct it for that year. The issue comes in if you get into an audit, right? So it's going to be very hard, and depending on type of business he's in. So that's why, like, I know you jumped in a little late, but we've been what we've discussed is like how to structure your company, and the tax implications and whatnot. But it depends on the purpose of your business. Let's say if he is in the business of building basketball courts, that is 100% deductible. That it makes sense. He may say that, hey, I was trying to do some research on like how this specific type of basketball court can extend the life, right? It's then in that case, it's not only deductible as a business operating expense, you can also claim research and development expense on that. So it's a very tricky situation when it goes into stuff like that, and it all depends on how your business is structured and what it is, what's the purpose of your business. Does that answer your question?
It does, yes. Thank you so much. Really helps.
Okay. And in terms of Insta and TikTok videos, I would say they can be helpful, but always before you attempt, one, it's how the disclaimer comes in, right? Do not attempt this at home. So if you're doing DIY, you're exposing yourself to a lot of risk. And also, if you do decide to go on that route, work with a professional.
Oh, for sure. I was planning on going to TaxZen.com for that.
All right, that sounds good. Thank you. All right, so we can go to the next section for Tax Cuts and Jobs Act impact on businesses. So what the Tax Care and Jobs Act passed by Trump a couple years ago does is like it lowered the corporate tax rate from 35% to 21%, and it also abolished AMT, which is alternative minimum tax. So no matter what you do, there's always going to be tax implication. And like the basketball court example, right? There are going to be loopholes where you can deduct certain things. But at the end of the day, IRS always comes back because their goal is to get the most out of your tax money, right? So what they do is it's called alternative. What they did is alternative minimum tax. Let's say in that basketball court example, they can say, all right, everything is deductible, but not the basketball court or any type of renovation that you do to the business or to the building. So that is where they plug that number back into your net income, and then they come up with this crazy complicated calculation that calculated your alternative minimum tax. So Trump went ahead and abolished it. So it was one of the good things that he did, which are very few. But for businesses, it was great. And I don't endorse Trump, by the way. I just endorse his business side of policies. So the QBI deduction, he also enabled 20% of qualified business income deduction for pass-through entities. So, for example, the pass-through entities are your partnerships, your S corps. So, and that really helped boost the economy for small businesses. Because at the end of the day, if you think about the U.S., right, small businesses are the backbone. They're like what I think 30 million small businesses registered across all over the U.S. So that makes up a big chunk. So that really boosted that side, and also like the income side, where for these small business owners, right? And if you get a K1 for partnership or S corp, ensure that you are getting that QBI deduction. And also qualified income taxable at 80% of the normal tax bracket on other business income. But however, this excludes certain type of professional service and investment income. So again, going back to the same discussion that we had before, how you structure your business and what you say the purpose of the business is determines your NAICS code. It's NAICS code. That determines how you get taxed and what type of deductions that you're eligible for. So, for example, I'm going to go back to Debesh's example again. So, as a CPA firm, if I put up a basketball court and say I entertain my clients there, that's an entertainment expense, right? That I cannot deduct. But if I'm in the business of like building basketball courts or the poles or even basketball itself, I can deduct that 100%. So it depends on how you're structured. So, and taxes for individual and businesses, both of them are like your DNA. Everybody's situation is unique. Things that are deductible for Debase may not be deductible for myself, right? And territorial taxes. So one another thing of TICTA, the Tax Care and Jobs Act, was taxes became territorial as opposed to global. So before it was a global thing, but there are certain things that you can do to make taxes for businesses territorial. So this was a good example for this would be. So I'm pretty sure you guys have heard that Apple and Google, they have a lot of money offshore in China or India, where they cannot bring that money in into the US because they would have paid that 35% tax. So they kept it offshore. What this did is this change in regulation made it possible for them to elect how much and what they want to bring into the US. And I don't want to get into too much detail on this one because it's not useful for us unless we have a big C corporation that needs it, right? Okay, so any question on the Tax Care and Jobs Act impact on businesses?
If anyone in the audience has any questions, just raise your hand and I'll pull you up and then you can ask the questions. No questions for now, Saurav, it seems.
All right, so I think we can open up to like just general questions, and make sure to follow us on social media, Facebook, Insta, Twitter, and LinkedIn. So we are a CPA firm, so we cannot put bogus content out there, else I'm going to lose my license. So, and also TaxZen is our tech platform. So even though it says it gets connected, so instead of just being connected to random people, if you follow our social media, you would get connected to our own CPA firm.
Do you just want to give a general overview of what you talked about today for the people that joined late?
Yes, definitely. So in general, what we touched on is when you incorporate a business, what type of business structure to follow, either a sole proprietor, which would expose you to any and all types of liabilities that come from operating a business. So definitely not recommended. Even where you're small, like forming an LLC is not that expensive. If you cannot put $100 towards an LLC, I would second guess your motive of going into business, right? And once you get an LLC, it's like depends on how you want to structure it. If you have multiple partners going in, then you will be taxed as a partnership where you'll have to file Form 1065. You can also go into an LLC and elect to be taxed as an S Corp, which is the best way to go if you are trying to run a small business for the longer term, right? But if you're trying to go for a tech side or any type of big business where you're trying to raise money and get it all the way to IPO, then it would be recommended to go C Corp route, because any type of investors out there will be looking for C Corp. And also you would want your C Corp to be registered at Delaware, in which case you would need a registered agent. And we do provide all of this services via TaxZen as well, where we can help you incorporate business. And we have developed certain technology where you don't have to be involved, or we don't have to be involved. It's all automatic, right? And what that does is, in terms of C Corp, or once you start going into business, what you'll have to look at is classification of employee versus independent contractors versus a business owner, right? So if you are an S Corp or partnership or an LLC, you would be considered a business owner. But C Corp, there's a whole different section that and complication that comes from it, right? And as a business owner, you'll get Schedule K1 that's going to get pulled into your personal tax return. As an employee, you'd get Form W2. And as an independent contractor, you get a 1099 MISC or 1099 NEC. So the forms included in your tax return would be Form 1040 for employee. Business owner, it's going to be Form 1040, Schedule C, Schedule SE, or even 1065 if you're a partnership. And independent contractor, you are going to have to report 1040, Schedule C, and you can deduct a lot of the write-offs that we'll be talking about. So there are three things that determine whether you're an employee or independent contractor: behavioral control, financial control, and type of relationship. So that's the way IRS is going to look at this, because if you classify somebody as independent contractor, you do not have to pay employer side of payroll taxes. So behavioral control is whether the business can control the work that the employee does or how the work is performed. Financial control is if the company has the right to direct and control all the businesses and financial aspects of the job. And the type of relationship, like the example that I gave was, if you're driving for Lyft, right, you can wake up and say, I don't feel like taking rides today, and you won't be penalized. But if you're an employee, you definitely get into trouble with the company, right? That's that. We also talked about use of vehicles and depreciation of vehicles. We talked about other write-offs that are applicable: technology, professional fees, marketing and operations, and administrative. And we talked about entertainment and how it's not deductible, and meals, 50% deductible for yourself while you travel outside of business, dining with a current or prospective client, consultant, or vendor, for employees, or at an entertainment event. 100% deductible is like if you open it up to all of the employees, or during a team building event, or for marketing event or presentation. We also talked about Section 179 deductions, and business use of homes. So Section 179 deduction, it lets you get the benefit of your purchases in the same year. So the example that I used was, I think somebody said they had the guy buy a Tesla, which he uses for business, right? He can deduct the entire amount that he spent on Tesla in 1 year. Or he can also elect to depreciate it over 5 to 7 years, depending on how you classify it. And we also briefly talked about business use of home with S Corp exception. You can deduct $5 per square foot of your home office space up to 300 square foot. And we talked about using the actual methods, office furnitures and office equipment. And then we talked about Tax Care and Jobs Act and the impact on businesses, how the corporate tax rate came from, max corporate tax rate came from 35% to 21%, and AMT got abolished, and QBI deductions for small businesses and territorial taxes. Right? I think that covers everything that we touched, Brishank. I know there's a lot of content in here, and if you have any specific questions, you can feel free to ask them right now, or reach out to us on Insta or via email as well, and then we'll definitely do our best to help you out.
James, do you have a question? I see you raise your hand.
Actually, yes. Thank you for pulling me up. My question was, I kind of got in late, but then it looks like a very informative session. Is it being recorded?
Yeah, so I'm recording this on Zoom. We also had a Zoom link posted on the group, but if you don't have the Zoom link, I'll be posting on YouTube. So check the SNN Facebook group where I'll be posting the YouTube link once I uploaded it. And Saurav will, once he updates our PowerPoint, I think he'll also be sending that to us, and we can post that as well.
Awesome, that sounds good.
Yep.
Thank you, Sam.
Yep. And James, are you in business, or are you planning on going into business?
I'm planning to.
Okay.
I'm graduating, so now
Got it. So one thing, I see that you're in biomedical engineering, and I think I briefly touched on it. I don't typically touch, or a lot of professionals that you work with will not touch on it, or they will not even know, because there's something called research and development credit, which is a cash money. It's a check that you get from the IRS, right? So if you plan on going into that, and one of the things that I'm trying to do is we're building content for NSF. I'm not sure if you're familiar with NSF. It's a National Science Foundation, which I think you are, but I'm not trying to assume anything. But what it does, it gives funding for small businesses. So if you want to get into it, let's chat, because these are things that a lot of people going into business or even professionals do not know. Especially like, and I'm not trying to discount it out there, because our CPA firm and the tech side. So we have a CPA firm and we have a tech platform as well, right? And we found this out going into this is like, and we are in Atlanta Tech Village. So just being in there is a lot of our clients is within Atlanta Tech Village itself. And we do a lot of research and development credit for those. So reach out to me and see like if we can get you into NSF. It could be like a very good funding source if you are planning on getting into it.
If anyone has any other questions, just let us know. Dibesh, I think.
I have a question, yeah. So this is just for clarification, and please correct me if I'm wrong. But in Canada, and I think the United States as well, if you have a small business or like you're registered under even like sole proprietorship or LLC, you're eligible to receive a line of credit that is not connected with your personal accounts. So the business would also have a separate credit score. Because it's not connected in such a way, like with your personal life and with your own credit score, is there a fixed amount of money you can pull out of that line of credit, or do they look at any other factors that determine the amount of loan you would be eligible for?
So that's a very good question as well. Debesh, man, you come up with all these great questions. That's awesome. So it all depends. So think about, I'm going to use this, and I've been using this as an example. When I first came to the US, right, I was 17. I didn't have any credit history. It was like I was an infant in the US. So for me, and I'm pretty sure this is the case for a lot of international students out there as well, right? Getting a credit card was hard because you don't have anything to back it up with. Essentially, you don't have any credit scores established, right? That's the same thing with business as well. So yes, you can get business line credit, but for your initial one, and it depends on the bank too. Some banks are very risk averse, so they will get you anything, right? But if you want to work with a good bank where they're not going to rip you off, they will ask you to personally guarantee it. And I briefly touched on this one when we talked about like different types of business structure. Is like the line of credit is a very good example. Is even after you have an LLC, you may be shielded from all the legal liabilities that comes out of it. But in terms of things like credit, if you personally guarantee the loan, then they can definitely come after your personal asset. But once you build the line of credit or build that initial, because that's essentially you are co-signing for your business. And once that credit gets established, then the business can have its own line of credit without your personal guarantee. In that case, you are shielded from it. And that's how you establish your business line of credit as well.
Awesome. Thank you so much. Your answers are always very informative. Thanks again.
Thank you.
And actually, I never got to thank you for that extra information on NSF content. Yeah, thank you for that. I was actually working on some other things and never got to reply you back. But yeah, I'll go through the recordings and then learn more about that. Thank you.
Okay, great. And I'll also share like because we are building it right now, and I'll also share any content regarding NSF with you as well.
I have a question.
Sure.
Saurav, is a lawyer required when forming an S corp?
No, they're not. You can do it yourself as well, but as soon as you get anything out of LLC, I would say work with your CPA. Lawyers can get very expensive unless you get into legal trouble. Because if you think about lawyers, right, they're there for legal purposes. But electing an S corp touches into tax and accounting, so I would say get a CPA. so that you can structure the S corp in the right way and the most beneficial way for your taxes.
Thank you. What about forming an LLC and to form the terms for the company? Is a lawyer required to make those terms to protect the veil?
They're not. You can download templates, and we provide free templates as well. So if you are going for an LLC, shoot me a note on Insta, and I'll pick it up from there, and I'll share our operating agreements and stuff, where you can and also guide you into forming the LLC the right way. Because one thing that a lot of people do is and some of the states are different. What state are you in right now?
California.
California. So okay, so with California, you even when you get an LLC, you do have to pay franchise tax, right? So California is a little different. California and Texas are different, where the LLCs have to pay franchise tax. So it's good to get a good lawyer, but if you work with a good CPA, he or she should be able to guide you throughout the way. And then at the end of the year, to file the taxes, you need a CPA anyway, not a lawyer, right?
Thank you. What state are you based in?
We are based in Georgia, but we serve clients throughout the world. So we have clients in US. We don't have any in Canada right now, I don't think. Thailand, Korea, Australia, and Mexico, and all across US.
Thank you. Thank you so much.
Hey, this is Dilly.
Hey, Dilly.
And I live in California. I'm a chartered accountant from Nepal, and I'm CPA and here CFA. But I work for a firm here, and just that is my little distribution, my little bit resume. So, and I have a couple of questions. If you can answer that for me.
Sure.
Thank you. So, if foreign person establish a corporation in the United States, what kind of, when they remit the payment to the foreign country, what kind of tax treatment? I thought something like 30% kind of withholding on foreign remittance. And basically, what kind of tax funds we need to fill for the foreign person?
So in that case, there's a lot of that gets into a complicated scenario where you get into FinCEN and FBAR. So there are forms 114 that they'll have to file, and also it depends on what the money is for and what's the purpose of the money itself, right? And if it's a regular course of business expense, you don't have to file FinCEN or FBAR. But if it's money that you're trying to hoard in a foreign country, then you get into a lot of international tax treaties and stuff and it also depends on what country you're sending it to and who you're sending it to. So it's very situational.
Okay, so let's say that somebody from foreign country established business in registered business in Delaware, and that Delaware corporation needs to file annual tax return and it to the IRS and annual tax return to the state. That is the annual income tax return. That's they need to file. Another they need to renew in Delaware, right? And
yep.
If they if that corporation has employees, they need to file payroll taxes on quarterly basis and annual basis. And then what else they need to file in terms of government filings? And then they need to file that 114 on annual basis to IRS. If they, how about if they own less than, there is a limit, maybe $10,000 or more. Is there any limit to file that 114 form to IRS, something like that?
No, that's so FinCEN and FBAR only gets triggered if you have foreign bank accounts, right? It's there is a limit. I think the 10,000 you're talking about is more like sending money offshore, where you will have to show where the money came from and who it's being sent to the bank. But FinCEN and FBAR, I think, has a higher limit. I forgot. I do not know the limits on top of my head, but it also depends on like how much percentage that person owns in the corporation itself.
Okay, so if it is 100% owned, what would be the situation?
Yes, they would need to file FinCEN and FBAR. And it would be good for them to get an ITIN here as well.
Say that again, what?
So it would be good for them to get an ITIN here in the US too, so that they can, if they do have a substantial presence here, they can file a non-resident return, so it's clear across the board.
Oh, ITIN. Okay, with IRS. So, and they need to. Then they need to file personal tax return and corporation tax return both in that situation?
If they have a substantial presence, so if they meet the criteria. So let's say they travel here, right, in 2021 and stay here for like 5 months, then they would need the substantial presence test. And then since they have 100% ownership of a US-based company, they would need to file an ITIN as well, and then report that income. They may not be taxed on it, depending on the country that they live in, but legally they're required to do that.
And then for the dividend, let's say, what kind of payment they can do? One is they can remit the profits, right? Profit distribution from, let's say they establish C corporation, they do profit distribution and send that money. So is that dividend tax?
Depends on the country and the treaty between the US and the country.
Okay, so based on that, dividend is also taxable for foreign person.
Yes.
In US, dividend is not taxable for US person.
It is taxable.
Oh,
in
dividend
US.
is taxable?
Yep.
For the C corporation.
No, on the personal side. So dividends get taxed on the personal side.
Yeah, but in personal tax, yes, C corporation get double tax. One at corporate level and one at personal level.
Yep.
But if C corporation remit the dividend, they don't need to do. Do they need to do tax withholding on dividend?
No, they don't. Nope, they don't.
Yeah, so they don't need to do. If they send money to foreign person, do they need to do withholding on foreign dividend payment?
There are certain cases that they would have to, where it's a mandatory requirement, where you need to withhold. But it depends on like other factors as well. So there is a mandatory withholding requirement for foreign people.
Yeah, and how that withholding reported to IRS? Do we need to report on quarterly basis, annual basis? How that gets reported?
That gets reported. I don't know. I have to look into it, but that gets reported because all the withholding should be reported on a quarterly basis. So this could be in one of the quarterly reportings as well. but I would have to look into that. I don't know the answer on top of my head for that.
Okay. All right, sure. So basically, if they remit payment to foreign country, then they got to do withholding and then report that to IRS and state government, wherever they do the. For Delaware, do they need to file local taxes to Delaware also?
No, they don't.
Delaware.
That's why you incorporate in Delaware, because you don't have to pay state income taxes.
Oh no, there is no income tax, and even if you don't need to file state tax. Okay.
You do have to file informational return.
Okay. All right. And what is the difference between incorporating in Delaware and other states? There are some advantages in Delaware, and that is not in other states. So, and I saw most of the corporation get incorporated there. What is the main benefit?
So Delaware, yeah, it is their business structure policy. It's very tax friendly, and also it's regarded. It's very well respected across all of the U.S. and all over the world. And the best thing is you don't have to pay income tax there.
But if you do business in California and you have Delaware Corp, you got to pay taxes in California, right?
Yes, as a foreign.
California too.
Yes, as a foreign corporation. But if you let's say expand to other states, right? As long as you don't meet the what you call it, not substantial presence. I forgot the term, but the benefit of incorporating in Delaware is that you are not subject to, like, so in your example for California, you would report as a foreign organization, not a California-based organization. Because as soon as you're a California-based, you gotta report franchise tax and all of that stuff.
But without it incorporating in California, they cannot do business. So they gotta do regular stuff for California, no matter where they incorporate, right? Why they do this extra thing incorporating in Delaware too? That's what my curiosity.
Right. You would what you would do is, let's say if you're in California, you pay, I think it's 800 franchise tax, right?
Yeah.
Plus other income taxes, plus the local tax, right? Because you have a physical location, right? Or you are located physically in California. But if you register it in Delaware, you are not physically located in California. To do business in California, as long as you're not using the local resources, let's say you sell online, right? You can sell to people in California or in Alaska, right? And you would not have to pay income tax on that. You would only have to pay sales tax if you meet certain thresholds. And you are not bound by the California weird laws, because laws in California are weird, right? As they say across the board. But you are not bound by it until and unless you are like, you have a big substantial presence there in California.
And somebody is registering in state of Delaware. Is that person or that entity need to file their tax return also there on monthly basis or not?
In Delaware?
Yeah.
No, it's Delaware you don't, but in California, if you meet the threshold or if you have a nexus. Yes, nexus is the thing that I was looking for, not substantial presence. If you have a nexus in California, you would have to pay the sales tax. It gets complicated. So what do you focus on? I heard that you're a CPA as well.
Yes,
what do you
I
focus?
work for a company here, CIM Group. That is the real estate investment firm. I'm the I look over the financial reporting here,
Got it.
but mostly getting companies audit done, reporting
Got it.
investors. Yeah.
Got it. Okay.
Before I was in Maryland, I was a CFO for a small company there,
Got it.
and I worked there about 7, 8 years, and then I moved in California
Okay.
5 years ago.
Do you practice tax as well, or just on the audit side?
No, I don't practice anything. I do taxes on my own taxes, and a couple of my friends' taxes.
Got it.
And yeah, sometimes my friend raises me questions, and then just I do a little bit research, and it looks like this forum is very good, and you are very informative, and then that's why I just ask you several questions. Thank you for your reply.
Yeah. Thanks. Yeah. What I was trying to test is. Yeah. Sorry. Go ahead.
Sorry. Yeah. So where do you base?
So we are in Atlanta, but we have both a CPA firm and a tech platform as well, and we serve clients across the world. So there isn't the limitation. What I was trying to ask was if you had practiced tax, I was trying to get you on the TaxZen side as well as our pro.
Yeah, I don't do taxes.
It's okay.
Yeah, I do just the personal, and then some of my friends, I help them do taxes, but I don't do it as a business until now, because what happened is from January to May, when we get most of the tax returns done, during that time I'm so busy in my work, and then after that I won't get any clients anyway. So
got it. Yep. Agreed.
That is the kind of situation. Now this is very peak time, but I got to work a lot during this time in my company. So
okay. All right.
Yeah. Otherwise, I would be also in tax practice.
All right, Saurav, thank you so much once again for being so informative and helping us all out. Like we said earlier, we will be posting everything on the SNN group and as well as YouTube. So Saurav, you can send me that whenever you update it.
Yep.
And then thank you once again. And hopefully everyone learned a little bit more. I know I did. And next week's networking session is on LinkedIn and networking. So that'll be cool too. So hopefully everyone can join for that.
Thank you.
Thank you.
All right. Thanks, guys.
Bye.
All right. Thanks, everyone. Bye.
All right. Bye-bye.